morning, everyone. We're just going to give it a minute for everybody to come in from the waiting room. All right. I'll just wait for that recording sound to come on. And it's already recording. Excellent. Well, good morning, everyone. Welcome. My name is Cameron Grant. I am the Senior Policy Analyst for the Simmons Chamber. Please join me in taking a moment to reflect and recognize the traditional lands we find ourselves on this morning. Today, I come to you from the lands of the Matakwamni and Matachewan First Nations in the Treaty 9 territory. I want to recognize the Anishinaabe Nation and Grand Chief Derek Fox's expressions and most recent expressions supporting the Grand Chief Allison Linkleader and the Mushkegowuk Council of Chiefs rallying in Ottawa this past week to defend their treaty rights to equitable health care. Something we should encourage our members of Parliament, provincial Parliament, to review very closely. I think it's important that we go beyond acknowledging the lands on which Indigenous peoples have held their traditional practices for thousands of years and understand when it is appropriate to use our platforms to amplify their advocacy efforts. Join me today in understanding your treaty rights and how you've helped promote them throughout your network. Welcome to our session entitled Leaving Your Mount Everest with Kevin Ballantyne of Copious Insights. Transition planning can be daunting for owners and SMEs who lack appropriate resources. The Chamber certainly recognizes this. Access to information on valuing your business ranked second on the list of barriers regarding transition planning from our latest report. Without accurate information, financing a transition plan and valuing the business can be complex, leaving many of you as business owners unsure of where to start. Accessing affordable, confidential, and professional advice is critical when drafting a transition plan to ensure a successful sale of your business and your most valuable asset. This series, and of course today's session, will provide participants with tangible work plans that assist in building capacity regarding succession planning templates, and also things that you should consider as you move through the life cycle of your business and your career journey. I certainly want to thank Maisonneuve Dawkins lawyers, Genie Financial, and MNP for their tireless efforts in support of the succession planning pillar. And an overview of today's session, effectively, your business is like climbing a mountain. You push to reach for the top. Shouldn't you plan on how you will prosper when you are done with your climb? This session will effectively overview with what makes up a complete exit plan and why it has a high return on investment, how businesses are valued and how to increase their value, and how to reduce the risk of involuntarily exiting your business. Joining me is Kevin Ballantyne, of course. He is a CPA and certified business exit consultant, providing business, finance, and transition advisory services through his own company called Copious Insights Inc. He specializes in business growth and improvement, financial analysis and forecasting, financial education, and business transition planning. Kevin is also a life insurance agent providing insurance and investment solutions with a focus on helping business owners with retirement, contingency, and estate planning. It brings me great pleasure to introduce Kevin this morning. And Kevin, I'll pass the floor right over to you.
Excellent. Thank you, Cameron. And welcome, everyone. Thank you for joining. I'm just going to share my screen here. That one, yes. Okay, you can see my slides now?
Yep, perfect.
Excellent. So welcome to my webinar called Leaving Your Mount Everest. The things I'm going to talk about today is a brief introduction, which is going to be very brief because Cameron did it for me basically already. I'm going to talk about the state of the exit plans currently in North America. What is an exit plan? Actually define it, and then talk about how businesses are valued and a conclusion. So this is me, and Cameron already mentioned this, so I'll keep going. So back in May 29th of 1953, Edmund Hillary reached the summit of Mount Everest, the highest spot on Earth. But it is Edmund Hillary famous because he was the first person to make it to the top of Mount Everest? Not necessarily. In fact, it is widely believed that others before had reached that pinnacle. However, Hillary became famous because he was the first Westerner to navigate the descent back down the mountain without perishing. The others who went before him are still frozen up there. Is climbing down the mountain harder than climbing up? Think about it. When you are ascending a mountain or building a business, your weight is behind you, pushing onward and upward. By contrast, when descending from the mountain, your weight is working against you. You need to avoid missteps that send you tumbling down. So, is exiting your business harder than building one? Very likely, yes. The next question is, are you frozen in your business? So according to the Canadian Federation of Independent Businesses, a report as recent as 2022, said in the next 10 years, 76% of business owners are planning to exit their business. And the value of all that is about $2 trillion just in Canada. And it takes 3 to 5 years to put your business in a sellable condition. It's important that you plan ahead for this. And sometimes things don't go according to plan, which I'll talk about a little later. Another survey said that 89% of business owners are dependent on the proceeds of the sale of their business to fund their retirement. Despite the absolute certainty that every business owner is going to leave their business at some point in time, either voluntarily or involuntarily, only 9% of them have a written exit plan for leaving their business. Interesting enough, past estimates show that only 10 to 20% of businesses on the market were sold. According to a CIBC World Market Study, of the group who do their plan, many have only dealt with the issues that affect their business. This is not a complete transition plan. I will discuss this a little later on what a business transition plan includes. With all of this in mind, it is disturbing to know that for most business owners, their business is their largest asset and are relying on the proceeds of the sale of their business to fund their life after business. So, do you have a plan when you started your business? Well, do you have a plan to exit your business and to protect your wealth? That's important questions because quite often, the average business owner spends 80 hours preparing their business plan, but only 6 hours preparing their exit. When business owners were asked what are the most important components of a transition plan, 50% of them said maximizing the business value. 40% said minimizing taxes, and a little less than 38% said control over how and when to exit. And then when they were asked, why haven't you prepared a business transition plan? Most of them said it was too early. There was also other things they said, like can't think about doing anything else, don't want to deal with the family and employee issues, no adequate advice or tools available, too complex, wouldn't know where to begin, too intimidating or scary, too time consuming, and the thought of being the end. So it's never too early to begin this type of planning, but it certainly one day could be too late. So if we go back to the story of Edmund Hillary, he likely had a plan to exit his trip to the top of Mount Everest. He followed one of the 7 habits of successful people developed by Stephen Covey, begin with the end in mind. This habit is important for you and your business. Ideally, you should consider exit planning when you start your business. If you haven't, you should start at least 3 to 5 years before you would like to exit. So the question is, does an exit plan have a high return on investment? Well, there are many challenges and obstacles in developing and implementing an effective exit plan. However, the benefits far outweigh the costs, and there are resources for business owners to turn to for assistance. Having the exit plan puts you in the driver's seat, allows you to implement growth strategies to build your company's current value and become more attractive to potential buyers. An exit plan considers how to build towards a future value that maximizes the long-term investment you've made in your company, as well as the probability of successfully completing an exit transaction. Without an exit, without a plan, exiting your business can be seen as a lot of work. As a result, many business owners wait until it's too late. These are the ones who either sell their business at a fire sale prices or die together with their business. So have you seen the movie Money Pit? I really like that movie, and it stars Tom Hanks. And in the movie, Tom Hanks asked the contractor fixing his house how long it would take. Contractor replies, 2 weeks. Tom kept asking him over the next several weeks or months, and the contractor would always say, 2 weeks. Business owners are very similar. If you ask a business owner when they are going to leave their business, they'll say 5 years from now. If you ask them 3 years later, it'll still be 5 years. Business owners often think that they can't afford to leave their company because it doesn't have enough value to fund their retirement. But they're not sure what they need to do to increase the value, but they think that they're able to fix it in 5 years. So what are the barriers to planning an exit? Often, it is the owners are too busy working in the business to take time to work on the business. It is so easy to get caught up in the day-to-day demands that they lose sight of the bigger picture and take steps to make sure that they take the time to work on the bigger picture. Another barrier is internal conflicts of parties involved by lack of a common vision or a lack of effective communication network. They're sometimes unwilling to consider the future or believe that they can wait. They are also a perception that the process is being overwhelming and complex. With so much information to be processed in a business exit, many owners procrastinate from doing it. Often the result is a failure to plan an exit, and again, loss of hard-earned wealth in an illiquid business. For preparation of the business exit will control the likelihood of you getting what you want. It is estimated that 85% of owner-operated business owners have one chance to exit a business. As with mountain climbing, the stakes are high and the mistakes can be permanent. Here's a visual way of looking at it. Let's start on the left-hand side of this chart. Early in the business, most entrepreneurs do 100% of everything. If it's you, you're doing it in the morning, and you're opening up in the morning and you're locking it up at night. You sold, produced, and delivered the product and handled customer complaints. You did it all. But remember, if your business cannot run without you, you're an employee, not a business owner. As years went by, you hired other people to help. That's a huge step. Your business grew, and you still knew and cared for everyone that was involved. Thus, it is critical you're making the success, 80% doing and 20% leading. Some entrepreneurs never get past this point. They get stuck. If you're at this level, your business has little or no value to anyone else unless they can get you as part of the deal. And I can tell you from my discussion with many that have signed contracts to stay with the company after it was purchased, you don't want to go there. After years of autonomy, it is very difficult to work for someone else. On the other hand, if you make a transition from working in your business to working on your business, to leading the company and doing the higher level of strategic thinking, planning, while training and enabling others to run the day-to-day operations, then you can have the business that someone else might buy. And since you're drawing a larger income from the business, you'll want to get rid of, they'll want to get rid of you so that they can capture that cash flow in the profits, setting you free to do whatever you want. Okay, so I've talked about the importance of business planning, but I haven't really, or exit planning, but I haven't talked about what an exit plan is. So this is my definition. A method of achieving the written goals for the succession of a business's ownership and control derived from the well thought out and properly timed steps that includes increasing the value of the business, best method of transfer, protection from unplanned events, and efficient distribution of the estate. Think of this process as an advanced form of financial, retirement, insurance, estate, and business planning, all wrapped up into one business exit strategy plan. So how do you go about creating the plan? I have a 7-step process. I believe that the first step is very important and often is not considered. Address the owner's current business concerns. How can a business owner consider an exit planning when they have other issues glaring at them? They could be worried about meeting payroll or a decline in sales and profits. The first step needs to be addressed so that the proper attention can be put on all the other steps. My favorite quote is from Albert Einstein. He said, "We can't solve the problems by using the same kind of thinking we used when we created them." So, in order to solve these problems, you likely need an advisor who can look at your business and your personal situation from a new perspective. It would also be good to have a lead advisor or coach to guide the transition team through the whole process and to help the team focus on the same goals and objectives. This person organizes everyone's special abilities and talents into a cohesive group. Step 2. What is the end that you want to achieve in the phrase, begin with the end in mind? This will end up being the frame of reference for the entire plan. It is the goals and motives that drive the exit strategy planning process. Setting goals will include goals for yourself and your business. It could also include goals for your spouse, your family, your successor. It therefore stands to reason that you should plan a meeting about your business exit with someone who can ask questions not only about your business and what you are trying to achieve, but also about your personal situation and what type of results you would like to see from the business exit so that your overall goals in life can be met. Clear goals increase your confidence, develop your competence, and boost your levels of motivation. Goals are the fuel in the furnace of achievement. After writing down your exit goals, every alteration that you make to your business should be directed towards achieving the end result of having your business continue in a profitable manner without your participation. Step 3, quantify business and personal resources and insurance needs. Will the amount of money that you have saved today outside of the business satisfy all of your future financial goals? If the answer is no, do you have any idea as to what you need in after-tax, after-fees, risk, and inflation-adjusted net proceeds from your business exit in order to meet your financial goals? It is important to measure this financial gap and work with a financial advisor who understands these concepts. This also includes finding out the value of your business, which is a critical determinant of whether or not you can afford the exit option that you most desire. If the exit strategy that you desire does not produce the value that you want to meet your personal financial goals, then you can, 1, grow the business to meet your goals. 2, execute a partial exit today in order to diversify yourself while still maintaining control of the business. Or 3, reduce the post-exit expenses, living expenses. These calculations go into your written exit strategy plan. Also included in this step is determining the owner's mental readiness to exit. This could be subconscious resistance to preventing you from protecting the wealth that you have accumulated in your business over many years. So still under step 3, have you clearly defined what life is going to be like leaving your business? Some of you say that you'll golf half the year, but if you hurt your back, what will you do? Or some may say, well, I'm going to be with my grandchildren. But what happens when your grandchildren are older and they want to be with their friends? So I've heard these situations with business owners, and is also is about to agree to the sale. So a business owner is at the point of signing on the dotted line to say, I've sold my business, and they end up not signing it because they're afraid that they'll lose their what they're going to do every day and their social network and their purpose in life, because they haven't planned what they're going to do going forward after exiting their business. And then it may be more difficult to find a buyer because you've reneged on that deal at the last minute. So I have 3 different assessments that business owners can take. One of them is called the Barry Report, or the Business Exit Readiness Index. And it determines the level of financial readiness and emotional readiness based on the answers you give in the report. It only takes 10 minutes, and you get a customized report afterwards. There's links on my website. The link for this one is under Business Transition, and or I can send it to you as well. So what ends up resulting is putting you on a square in this quadrant, one of these quadrants. So depending on where you lie, if you have a low mental readiness for an exit or emotional readiness, and a low financial readiness, well, we'd say you're a stay and grow owner. You want to stay longer in order to grow the value of your business. If you have a low mental readiness but a high financial readiness, well, you're well off and you want to choose to continue to work. If you have a high mental readiness, you really want to get out of that business sooner than later, and your low financial readiness, you want to get the highest price possible and get out. And I'll talk about some of the options for these things. So if you're high mental readiness and a high financial readiness, well, you're already rich and you're ready to go, and you would just sell the business. So from that, we can then determine what are some of the options that you can look at how you're going to transition out of your business. So I mentioned this is the stay and grow quadrant, and here are some of the options. So PEG, recap, what that means is PEG stands for Private Equity Group, and a private equity group is an organization where investors put their money, and then they go out and buy private businesses. Sometimes what they do is buy a percentage of it, not 100%, but say 80% of the business. So if you were to sell your business to a PEG, they would buy 80%, you would keep 20%, and then they will inject more cash into it and grow the business, maybe have it in a different geographic area, or invest in a more manufacturing plant or whatever. And and after 5 years, pegs like to sell their shares so that their investors can realize the gains that they've realized. And that 20% that you had could end up being worth more than the 80% that you got at the very beginning. So that's a PEG recap. ESOPs, ESOP stands for Employee Share Ownership Plan. So that's where a plan could be in place where employees of your company can buy shares into the company. And that doesn't necessarily need to be 100%. It can be a percentage of it as well. The other ones are just growing your business and of course, increasing your savings outside of your business. If you're low mental readiness, but of high financial readiness, here some of the options are management buyout, that's the MBO, gifting it to family, or an ESOPs again, employee share ownership plan. Over with a high mental readiness and a high financial readiness, there's also the possibility of charity and selling. And if it's a low financial readiness but a high mental readiness, well, that's when you're looking for the highest price, and maybe to a strategic or strategic buyer that has synergies, and they'll pay the highest price. Another assessment I have is called Owner Dependence Index, or ODI, and that basically measures how dependent is the business on you as an owner. And it looks at 8 specific areas for improvement. And the areas are there. Now, you may not be able to read that, but they are owner involvement, internal operations, strategy and planning, governance and ownership, financial matters, performance management, sales and business development, and company culture. And why do you want to increase the value of your business? Well, this looks at your current savings that you have outside your business, and then how much do you need in order to fund your retirement? And the value gap is the difference. So if your business needs to fill that gap, is it worth enough to do so? Okay. Should I stop here and just see if there's any questions? Is there any questions, Cameron, in the chat?
I think not at this moment, but we're building good momentum. So I'll let you know if anything pops up.
Okay, great. Step 4 out of 7 in the process is maximize and protect the business value. So according to the US Chamber of Commerce study, only 20% of businesses that are for sale will successfully transfer hands to another owner. That's unfortunately a very sad statistic. The factors that make the business saleable include good management teams, steady and defensible profits, customer and vendor diversification and loyalty, a solid reputation, predictable transferability, intellectual capital, and many others. It is important for potential buyers of your business to see that you can plan out the future of your business for growth, and that you actually meet that plan. This growth plan will need to be understood. We'll need an understanding of the main drivers that increase the future value of the business, and to focus on them. When business owners begin to view their business as an investment and not as a job, they begin making better financial decisions. Many exiting owners don't appreciate the amount of risk that truly exists in their business. Buyers or successors of your business will pay you a multiple of your company's cash flow, depending on the risk that they perceive in your business. And I'll talk about that a little later too. The higher the perceived risk, the lower the price that they can pay. Understanding the true risks in your business is a large part of the process. So this step includes determining how to increase the value of your business and taking steps to make that happen. It also includes protecting you and your business from various ways that you could lose value. So the third index that I have is called the Growth Planning Index. And it helps to start that growth planning conversation. And it determines where you are in the stage with regards to growth and transition process. How much commitment do you have for both of those? So when I help a business increase the value of their business, I'm looking at it this way. And this is really how potential buyers of your business are looking at it as well. So the first area we look at is the predictable profits and cash flow. So we set that foundation so that we can grow the business from there. What this stage also does, and it also from that GPI index, if we determine which of these three steps to work on. So for instance, if all you want to do is a lifestyle business, but you want to make it less dependent on you, then we would only work on this predictable profits and cash flow area. If you say, well, I really want to grow the business, expand it as much as possible, then we'd still work on the predictable profits and cash flow, but then we'd move to predictable revenue growth when we're done. And that would help to grow the business. But if you said, well, I want to I want to grow the business and then transition out of the business. So we would work on predictable profits and cash flow. Second would be predictable revenue growth. And the third would be this predictable transferable value. Or if you said, well, I want to transition out of my business and I want to do it fairly quick in the next year or two, then we'd probably just work on this predictable transferable value. So what are the things that we would work on in each of these? Well, in the first one, predictable profits and cash flow, we'd look at senior management, human resources, recurring revenues, margins, financial and operating reports, sales plan and process, operations, and customer satisfaction. And I have a whole process that I go through for each of these. And they can be tailored to whatever you're wanting to do, or if you've already got some of these perfected, then we don't have to do anything with them. So the next one was predictable growth. So we'd look at company strategy, culture, market size, recruiting and training, product differentiation, marketing plan and process, budgeting and forecasting, and innovation. And then the final one was predictable transferable value. So business profile, potentially an audit, legal, growth in the market share, customer diversification, barriers to entry, and brand. Also part of this step is figuring out how to plan for the owner's retirement. And some of the tools I have in my toolbox are things like these IPP and another one called PPP, which is, so the IPP stands for Individual Pension Plan, and PPP stands for Personal Pension Plan. I especially like the PPP because it includes 3 different components to it. So down at the bottom, it talks about DB, which stands for defined benefit. So a defined benefit plan says the benefit that you'll get from this pension is equal to what the benefit is defined, and not necessarily how much you've contributed to the plan. A defined contribution is you contribute money to your pension, and then it grows in the pension through investments. And at the end, you have so much left over, and that defines how much you'll get. And then there's also this additional voluntary contribution. So you can even add more to the pension plan. So these are the three components I just talked about. And it can potentially mean contributing a lot more than what you could do with an RRSP. So it might look something like this. So an RRSP, the maximum contribution is around $26,000 a year, but an IPP is quite a bit more, and a PPP is even more than that. So that was step 4. And step 5 is the ownership transfer plan. So how will the ownership be transferred to meet all of the goals laid out in step 2 in the most effective and efficient way? So this step considers tax planning to minimize capital gains and investment in the sale proceeds, analyze possible legal issues, cash flow timing strategies, identifying the successor and are their goals compatible with yours, financing options, possible estate freeze, and funding an expected tax payment. Too many owners of privately held businesses believe that selling the business is the only way to exit. They do not understand the motives of the players, and more important, they do not understand the options for exiting the business. As a result, they seek the counsel of transaction advisors and engage in the services with less than perfect information. The goal of advisors that focus on the relationship rather than the transaction is to help you to reach your goals, keep you happy by providing good representation, good service, and attempting to add value to your business and personal situation where possible. Another thing that is good to do in this step is a due diligence checklist. So when you're in the process of selling your business, the buyer is going to go through a due diligence, and it's extreme. I've helped clients provide what they're asking for in the due diligence. So I think it's a good idea before the sale is to do this checklist yourself to make sure that you've got everything in order and you can present it well to a potential buyer. Now, step number 6, I think, is very important. It's contingency plan. And it's simply a process implementation plan that is triggered by some event, emergency, or new information. The event or emergency may or may not happen, but it is liable to create a significant business problems, potential or real liabilities, if not dealt with quickly. Consider when a business owner dies or becomes disabled, most businesses have the momentum to run business as usual for about 4 to 6 months before the business starts to decline. Vendors get worried, key employees start seeking other jobs, customers start seeking alternative sources for their products and services. There's several things you can do that can be done to protect you and your business under these possible what-ifs. And I'll talk a little later too about buy-sell agreements. I find that a lot of business owners don't have a shareholder agreement or a buy-sell agreement, or if they do, they haven't finalized things. They haven't. It's in a draft form. It's not signed, or even worse, they haven't even started it, and it can create a lot of problems later on if something were to happen to one of the shareholders and these agreements aren't in place. So the contingencies we're looking at are the 4 Ds: death, disability, divorce, and departure. And consider it in terms of the owner, the co-owners, the plan successor, key employees, suppliers, and customers. Some of the tools to help include in this a shareholder agreement, buy-sell agreement, life insurance, disability insurance, estate freeze, tax planning, trusts, joint and several liability, stay bonuses. The stay bonus A stay bonus is a bonus to pay your employees after a period of time. So if you become disabled, for instance, and you're worried that your employees may leave, but you want them to stick around for at least 18 or 24 months so that you can plan your sale of your business, and it would be worth a lot less if some well-experienced key employees were to leave. You could offer them a stay bonus, and that bonus would be paid if they stay for that period of time. And you can fund that bonus by using insurance. And also consider a marriage contract. So shareholder agreements, I already mentioned some of this, but it's important that you have that and you have it in place. Preserve control among, what it does is it preserves control among existing owners. It avoids disruption in managing the business. It's estimate a market for otherwise illiquid assets. So you can come up with a formula on how the business will be valued when the time comes to use some of the agreements within the shareholder agreement. It resolves dissension among shareholders and establishes a predetermined method of setting that fair price, and then funding it through life insurance. The shareholder agreement can prevent a spouse from gaining interest. So if one of the shareholders dies and the other owners, shareholders don't want that owner's spouse to be involved, then this agreement can lay out how that spouse will be compensated and not end up with shares of the business. It can save the obtaining of costly valuations, and it can provide a formula for determining the value to give the corporation and shareholders option to buy a divorcing shareholders. So even in the case of a divorce. And then even with a disability, so it's defining what is a disability and how long you're going to be disabled before it enacts a buy or a sell. What if the full and complete recovery, what happens at that point? How long to receive salary and bonuses while they're disabled? Continue to vote or not, or someone else vote? Maybe they're not able to vote. They're in a coma or whatever. Share purchase and redemption of so there's different options, whether we're actually buying the shares of that disabled shareholder, or the business is buying back the shares from them. That's what a redemption is. Insurance can do many different things for the business and for the shareholders of the business. It can pay debts, pay taxes on deemed disposition, pay stay bonuses, already mentioned what those are, cover dependents' expenses and replace income, fund emergency expenses and children's education, assist in funding the succession of the business, allow for the accumulate funds on a tax shelter basis. So it's another way of saving for retirement. And there's actually an excellent strategies that you can use when it comes to insurance to accumulate value and even fund retirement. Estate equalization. So that means if you have children that some are wanting to be involved in the business and some that aren't, you can use insurance to help compensate and make it equal amongst the children that aren't involved in the business. Insurance can also provide income during disability. It can fund a buy-sell in it when there's a disability, help manage risk for cash flow problems, pay debts, rent, utilities, and even some payroll. That's called an overhead disability insurance. It's important if owners if there's a personal guarantee on debt, They have insurance related to that as well. Critical illness. So if you have, if you become ill and have certain types of illnesses, you can get a lump sum, and that lump sum can be used any way you want. Some use it to even take a family on vacation, or to have care brought in. People come in to care for you, or build a ramp on your house or whatever. Long-term care insurance is insurance to get reimbursed on expenses that you have when it comes to providing for the necessities of life, basically. So if you're not able to cook for yourself or go to the bathroom yourself, then you can get reimbursed on the expenses for that help. And proper structuring needed so it can reduce or eliminate a tax benefit, and sometimes the premiums for these insurance can even be deductible. And we can look at whether the corporation should have the insurance or the shareholder personally have the insurance. So lots of possibilities. Step 7 is the estate plan. So by not including your business in your larger estate planning objectives, you may compromise its succession and survival. You should view the exit plan not only as leaving something behind, but rather not as leaving something behind, but rather as stepping into something new and exciting that lies ahead. By the same token, if you should plan your estate, not to challenge your thoughts or immortality, but rather to recognize the fact that the government has set the rules of the game, and you can end up on the losing end if you do not make your own plans for your inevitable exit. Things to consider within this step would be wills, power of attorney, creditor protection issues, eligibility for lifetime capital gains exemption, capital gains rollover to a spouse or a spousal trust, cash to cover tax liabilities, tax on assets outside of the province or country, and reducing probate fees. So an estate plan to ensure it's updated regularly. Who will run your business if you're not there? Will it be sold, or will it be continued or liquidated? Who will the heirs consult with? Who are the advisors? Possible second will to avoid probate. So if you attended the last session with the lawyers, they mentioned the second will, and I think that's very important to have that as well. That second will would be tied to your business, where the other will would be for your other assets. Powers of attorney, you would have that for property and for care. Possible use of trust. An example of that would be if the shareholder died and their spouse survived them, and that spouse may end up marrying somebody else and they have children, you could use a trust to make sure that the money, your estate, goes to support your spouse, and when your spouse dies, then it goes to your own children and not somebody else's children. And then there's buy-sell agreements and post-mortem tax planning as well. So the time to start thinking about selling your business begins when you start your business and throughout the life cycle of your business. And if your business is your retirement nest egg, consider every major decision and how it will add value to your company's exit plan. And it's important to put together your advisory team. So what I do is I'm a business transition planner or a consultant, and I'm like a conductor of an orchestra. I help, I lead the other advisors in what needs to be done as well, because I've got a really strong understanding of the business owner and what their goals are, what they're trying to achieve, and encompass the big picture of everything that's going on. So helping to work with the tax experts and the lawyers and the financial planners so that um, everybody's working in one concert. Is there any questions now, Cameron?
Still smooth sailing, Kevin. Good to go.
Okay. So the next part I'm going to talk about is the business value, the value of the business. And why does that matter? Well, there's a lot at stake with the business owner. And the business owner's hard-earned value can be diminished very quickly with changes in the business or the economy, the fact that there's a lack of a successor, even income and capital gains taxes, and dealing with advisory fees and deal structuring. And the private held business typically is the largest asset of that owner and the primary source of their income, and it's a vehicle for paying their bills and a source of pride and legacy. So I mentioned at the beginning that 76% of business owners are planning to transition out of their business in the next 10 years. But you think about it, 3/4 of all business owners want to exit all within this decade or the next 10 years. And that's a lot of businesses going onto the market all at once. And how are they going to convert this illiquid primary asset into cash and replace the income from their business? It's and protect their legacy and to support their themselves, their family, and their employees. Well, a big thing is that mindset, and to have to consider your business as an investment and not as a job, because the acquirer of your business is going to look at it as an investment, and you got to be thinking the same way. To successfully transition, business owners need to see their business as an investment. And it's important to diversify your business as well. So not necessarily your business, but all of your assets. Because if you got all your eggs in one basket, then there's a much greater risk to you. And and the typical portfolio of a business owner might look like this, where the private business makes up a large majority of their total assets. So what is a business worth? Well, believe it or not, it's a range concept. It's not one particular number necessarily, and that what it's worth will depend on who is going to buy your business, whether it's a going concern or liquidation, and then looking at expected cash flow. So I recently taught a course which I'll talk about at the end. And one of the students said, well, how many years back do they look at when it comes to their financial statements? And I said, well, it doesn't necessarily look like they'll look at your past statements, but only as far back as they can help to use that information to predict the future. Because what they're really interested in is the future. How much income and cash flow will that business generate, and how likely will it to continue to generate that income in the future? And that perceived risk is that how likely factor. And then it'll also depend whether they're purchasing a controlling interest in your business or a minority interest, because a minority interest would not be worth as much per share as a controlling interest. So one way to look at it is there are internal transfers and there's external transfers. So under internal transfers, it could be a family member, it could be an employee stock ownership plan, or it could be management buyout. And external transfers, there are financial buyers and there's strategic buyers. So a strategic buyer, I mentioned before, is a company that buys your business and they realize synergies from that, from buying it. So it's like 2 + 2 = 5 or 6 or 7. And so the values that each of these buyers would pay, it can be different. So for a strategic buyer, they're going to pay more. It's a higher market value with synergies. They're saying, well, we can increase our sales or lower costs or increase our profits, all from that purchase. So they're going to pay the most. Then there are financial buyers that say, well, I'm buying that business and it's going to continue to be a standalone. So I'm not going to pay as much as a strategic buyer would pay. Then a management buyout will be a very structured investment value. And then there's a defined fair market value that employees or family would end up paying. So the range of values may look like something like this, where the fair market value for a company is 7 million, a market value from a financial buyer is 10 million, a synergistic or strategic buyer might pay 12.5 million. And this last one is unfortunate, where this is what the owner thinks it's worth. I was involved in helping a client buy a business, and I asked the seller, where did you come up with your value? And he said, well, that's what I need. But what they need isn't necessarily what it's worth. So unfortunately, what he was asking for was more than what it was worth. So here's the definition of a fair market value. It's the price at which the business would change hands between a willing buyer and a willing seller when the buyer is not under a compulsion to buy and the seller is not under a compulsion to sell, and both have reasonable knowledge of relevant facts. That's the definition. So when a certified business valuator is looking at the value of a business, they normally look at it in 3 different ways. One is income approach, which might use net present value of future cash flow. The second is the assets. What is the market value of the assets that they're purchasing? And the third is market. So that's what are businesses in the market similar to yours selling for, and what have they sold for recently? So filling that gap I had talked about earlier is something like this. So if the business is generating $100,000 of cash flow, and a multiple of 3 would mean that the lower the multiple, the higher the risk that the potential buyer is looking at your business and saying, this is a riskier business. I'm concerned that this current cash flow may not continue into the future. So then I'm going to pay a lower multiple. And so with that, the value of this business would only be $300,000. But what I help businesses do is to both increase the cash flow. So if we can increase it from 100,000 to 300,000, and then also make it less risky from a potential buyer's point of view, thus increasing this multiple from 3 to 6, we've substantially increased the value of the business. When a business owner is thinking about increasing the value of the business, they're usually just thinking about this part. How can I increase profits? But that's only half the equation. The other half of the equation is helping them to decrease the risk from a potential buyer's point of view. But when it comes to the synergistic value that a strategic buyer would want to offer, they're looking at how the 2 firms can provide better value together. So that 2 + 2 = 5 or 6, right? And some of the things that they may look at is revenue enhancement. The two firms together will have more revenue than the two heads separately added together, right? Or there could be cost reductions. So because we're a bigger firm now, we can get economies of scale. We can negotiate better pricing from our vendors, whatever. Maybe the firm being acquired has processes in place that the buying company can use to lower their costs, and thus their processes are all improved. Financial economies, that's where the they may end up getting lower interest rates from their banks because they're borrowing more and they're a bigger, healthier company combined. And then the risk reduction, that's where that multiple. So together, the two companies together would end up lowering the risk from a potential buyer's point of view and thus increasing the value. So they see synergies and improvement that way. So I have a long list of specific company risks that that would be looked at on. But if you can lower those risks, you can potentially increase the value. So here's the list: lack of access to capital, ownership structure and stock transfer restrictions, the company's market share and the market structure in the industry, the depth and the breadth of the management. How experienced are they, and how good are they at running that size of business or a bigger business? Is there a heavy reliance on individuals with key knowledge, skill, and contracts? That could be a risk if one of those individuals were to leave. Marketing and advertising capacity. What about the breadth and of the products and services? Purchasing power and related economies of scale. The condition of the facility and the upcoming capital needs. Customer concentration. So that talks about if one customer makes up a large percentage of your total revenue, that's a risk from a potential buyer's point of view. How are the vendor and supplier relations? And are you totally reliant on that one vendor so that if something were to happen to that vendor, that could be a risk for the company as well? Do they have distribution capabilities? Is there ability to keep pace with technological change? Is there ability to protect intellectual property? What about the threat of foreign competition or possible litigation with environment or adverse regulatory issues? And what about the depth and accuracy and timeliness of account information and internal controls? So if the internal controls of your company are not good, that could put you at risk of fraud, or that the financial information provided is not as accurate as it should be. So evaluation summary, in summary, valuation is a range concept. It is based on adjusted, so the income option instead of assets or market is based on adjusted future cash flow and the risk factor. So in order to increase the value, you would increase cash flows and you would decrease the risk. Are you ready for an exit? It is critical to position your business in the prime shape to sell. So some of the questions you might want to ask yourself are, if a competitor or financial buyer knocks on your door, would you be ready? Do your financial statements accurately portray the value of your business? And do you know where your company stands versus your key competitors? Have you identified the gaps or issues that threaten your continued success and growth? And if you had to leave the business today, would your company continue to thrive? And there are real advantages to documenting this whole process for planning your exit for your business. What gets documented is more likely to be done, and have measures in place in case something were to happen to the owners. Details of the structure of each alternative and the net financial effects is laid out. Go into negotiations prepared and confident, and by knowing your financial and mental readiness for an exit, provides you with different options that help to meet your goals. So, in summary, 76% of business owners are planning to exit their business in the next 10 years. And major implications are, if you don't have a plan, that the exit plan has a high return on investment, and it's overcoming those barriers to planning that exit is very important. But planning your exit from the start, or at least 3 to 5 years. But remember all of that talk I had about contingency planning. So your 3 to 5 year plan may end up being much shorter than that if something were to happen that wasn't planned. And follow the 7 steps to an exit plan. And the big part is that you and your family depend on it. So as I mentioned, I have a course. It's called Finance for the Non-Financial Leader. Some of the things that we talked about is included in the course, but this is a 2-day course compared to our hour and a half here. Part 1 and 2 is going to be sometime in April. We haven't set the date, but it's going to take place in the Timmins Chamber boardroom. And in part 1, I cover understanding financial statements, improve financial reporting to get more out of them. What are the key performance indicators that are useful for your business? Factors that increase profits, growing profits through analysis, and improving cash flow, and some other useful reporting ideas. In part 2, I talk about how businesses are valued, so I go into more depth than I did here. How to increase that shareholder value, documenting your transition plan, contingency planning, strategic plans, talk about budgets and forecasts, making investment decisions in your business, break-even analysis, and financing your business. So it covers a lot, and I just had one of these earlier this month in the New Lister Chamber of Commerce, so bringing it to Timmins. Oh, are there any questions or comments people would like to say?
Kevin, just while I see if there is any in the Q&A and or chat box, I mean, this was a very thorough presentation. And so if there aren't any questions, I think it's only because the conversation and any questions that subsequently that they may have had were answered as a result of the flow of the presentation. So at this time, I do have a question, though, that we've been hearing from our members, particularly because we had launched our very own sort of benchmarking business succession planning report. It stemmed from the survey that we had launched in 2022 and benchmarked the questions that we had asked back in 2019. I saw some similarities and some trends, obviously, from the CFIB report. And so Timmins is not facing any unique challenges when it comes to actually bolstering it and setting ourselves up for, proper succession planning. I think it's so appropriate that you discuss and use the metaphor of climbing your Mount Everest, because leaving obviously is something that nobody ever thinks about, but it is so critical when it comes time to do so. And oftentimes the planning occurs a little too late. To you, and with the business owners that you've worked with, particularly on exiting, their business, what is the one thing that you hear from them that they wish that they would have done much sooner, if you could provide one piece of advice?
Well, I think the biggest thing is if they had started sooner, they would have been able to increase the value of that business and get more for it than what they got when they sold it.
So, I mean,
that's the biggest thing.
It is. And I mean, it's the length of time at which you take is going to equate, without a doubt, more basically a nest egg for your retirement. which, people are living longer these days. You want to ensure that you have a sustainable, dignified retirement. And so obviously getting top value for your most valuable asset is key.
Yeah. And I find too that if they wait, like sometimes just the tax planning takes 2 years to put in place, because they'll say, Revenue Canada says you can't do certain things in the way that you're planning that sale, right? You have to be doing it for other reasons. So if you restructure how the ownership of your company right before you exit, then that's telling Revenue Canada that you did it because of that exit and not for some other reason, right? And that could end up costing you more taxes. Right?
Yes, and we know that the CRA is very effective in following up and seeing how those things go. I guess the final thing that I sort of wanted to touch on, it's only because you had mentioned it. So, we've heard from some of our excellent pillar partners, Jenny Financial, Mason & Dawkins, as well as MNP. So we have a lawyer, a financial planner, and accounting firm. To you, in your opinion, what is sort of the first door that exiting business owners should knock
on? I don't like tooting my own horn, but I think it's important to talk to an exit planner like myself as the first step, because that's where you would, get a clear sense of, well, following the steps, right? What are the issues that you're dealing with now? What are your goals that you're trying to achieve? And then looking at the different options, because if you go to one, they may not be connected well to the second one, right? And that's important to have kind of that concert conductor, right? Someone that's going to connect with all of your experts and make sure that your goals are clearly defined, and these experts know those goals, and that they can work together. So that it also eliminates some of the overlap that may occur if you're dealing with these advisors separately, and having to go over your goals separately with each of them, right? It could end up saving time with your accountant, your lawyer, your financial planner. So,
and I greatly appreciate as an orchestra player myself, the metaphor of the conductor. They're not just somebody waving their hands around, they are the force that binds. And so it's always important to have that person in your corner. Kevin Ballantyne, I really want to thank you, obviously of Copious Insights, for your presentation this morning and this afternoon as we approach. Certainly appreciate the oversight. I think this is a great sort of umbrella wrap up of the webinars that we had held for succession planning. We know, and we can tell by some of the attendees, that there is going to be a shift in the very near future, probably 3 to 5 years, of some significant assets in Timmins. And so we want to ensure that not only those legacy businesses are well supported and stay in our community, but that also that those legacy business owners are well supported in their retirement. So on behalf of Mason & Dawkins, Jenny Financial, and MNP, I want to thank you for your time today. And we certainly look forward to our collaboration in the future.
Okay. Thank you very much. I appreciate it.
Thank you very much. Take care, everybody.
Okay. Bye now.